Manish Gunwani joins us now. I always look forward to engaging conversations because he's got a range of topics which he always shares his view on. So Manish, fantastic to have you back. Thank you for joining us. Manish, I can easily divide the world into two: the optimists who believe that economy will recover in the second half, vaccine will be discovered, and India will benefit because of crude. And then you've got the realists, not pessimists, but the realists who feel that economy is in a long, slow, but a painful patch. Nothing will come this year on the vaccine front, and despite the odds, markets currently do not offer great value. Which camp are you in? The realistic camp or the optimistic camp?
Well, Nikunj, actually, let me give you a nuanced view. Actually, see, I don't know about the economy, what pace it will come back, but I'm just saying that the ask rate of a lot of stocks is not very high, in the sense that what you're saying is whether the economy will come back in 1 year or not. I'm saying if you start from the other perspective, that what are the stocks building, what are the auto stocks building in, what are the retailing stocks building in, what are maybe the bank stocks. I think banking is a bit more tricky, but a lot of these cement stocks maybe, even if the economy comes back in 2-3 years, you will get 50 to 100% return. So unless there is a structural change in consumer behavior because of this crisis, and that, to my mind, can only happen in some very niche segments that you can debate that multiplexes may get disrupted or whatever. But clearly in cements or commercial vehicles or retailing, I don't think anything structural is going to change. So the point is, to my mind, the next 6 months, 12 months, maybe even 18 months may look very, very tricky and pessimistic on the economy. But I think stocks build in a discounted cash flow of 20, 30 years. So whether 1 or 2 years really should not affect the intrinsic value of stock as long as they can survive. Now, which is why my view has been that the easier call is to buy operating leverage. The trickier call is the banks and the financial leverage stocks. Because obviously, you will make much more money on them if you get it right. But that is something, I think there you have to just calibrate, seeing how the global economy is doing, how a virus cases in India, and then maybe you buy when you see some clarity. But where you have debt-free balance sheet in a lot of these cyclical sectors like cement, auto, and all, I think you can afford not to wait for good news, assuming that at least economic activity 2 years down the line will be the same which was there in FY20 pre-COVID, and still get maybe 40, 50, 70% return.
It's a great point, Manish, that you value stocks based on earnings, terminal value, and the yield curve. And the yield curve is headed lower, and the earnings the next 2 years, the aggregate earnings for next 3 years may not be all that damaging. But I'm going to spend some time trying to understand banks. Because if you are of the view that the collateral damage for earnings is not going to be that large and earnings will come back 6 months here or 6 months there, then why do you have a slightly nuanced view or a slightly tentative view on banks? Because if economy comes back, the leverage economy has to come back, credit has to start, and there are only few banks left which will have to do all the heavy lifting now.
You're correct. The relative call again in banks, to my mind, is quite clear that just like what is happening in many other sectors, the large private banks will get market share from most of NBFCs, most of regional banks. The only thing about banks is, of course, their leverage 1:10, 1:12. Now, you could see a lot of capital raising because if the asset quality goes bad, or even if it doesn't go bad, but people are concerned, and you are seeing that, right? I mean, you're seeing fair amount of capital raising. So till that phase plays out, and let's say there's a second wave of virus somewhere down the line, then any leverage balance sheet is what you will be a bit more concerned about. So my point is that you can take a 3, 4, 5-year view much more easily on a operating company without debt, and they are also quite cheap. Banks is the relative call, as I said, is easier. The absolute call, I think, maybe a bit trickier. But yeah, I mean, if you have, again, a very long-term view, large private banks are good places to be.
You mean the big five, right? That's what one should stick by, Manish? Just getting a clarity on it.
I think the way things have panned out, the ones with slightly higher corporate exposure may be better off, because clearly the way things have happened is that the personal credit, especially unsecured credit, is much more open to question after this crisis, and that is where the valuations have been higher, where you have 3, 4, 5 times book. While these stocks also have corrected, there obviously are large private banks with half corporate, half personal, which are at one time book maybe adjusted. So to me, this latter is probably the easier call at this point of time.
Sure. Manish, how does one approach FMCG? Because many debate that life has come to basic essentials. FMCG is not going anywhere. The other angle is, of course, some of the rich valuations, 60p multiples that some of these stocks are still trading at. But at the same time, you even have names like ITC, which are getting badgered because of, what may come by in terms of higher taxes when it comes to cigarettes and, of course, the lockdown impact. And then you have companies like Dabur here, which have taken quite a hit when the earnings came by because of COVID. But, I'm just looking at the strength of cash flows and balance sheet. That continues very well. And if the entire debate about rural India is going to lead the recovery, is going to be the case, then, companies like Dabur, Godrej Consumer Products do stand to gain.
No, I think incrementally, whenever this crisis fades, obviously even FMCG fundamentals will improve in terms of growth and profitability. And they also have a tailwind in terms of lower commodity prices, because almost every FMCG company, the packaging material linked to crude and all that. But the challenge I see is that India is a place where you have very high fixed income rates relative to the West. So the argument in the West typically is that the dividend yield on a Nestle or a lot of the big pharma names is more than what you get paid in the bank. Here also, good part is now with rates coming down, the bank FD rates are coming down. But if you look at bond markets, I mean, you get some really good bonds at 8, 9, 10%. And while FMCG stocks X 1 or 2 also have corrected, free cash flow yield doesn't look that exciting to me, because you're starting with 1 to 2% kind of free cash flow yield. And where, as I said, in an economy where your state government bond is probably yielding you 8%, given that the top line growth of these companies is probably going to remain 9, 10, 11, 12%, whatever, it's difficult to be very excited. I mean, obviously, over the next 1 year, where there's a lot of uncertainty, some of them will be good places to hide. And the terminal value of these companies is unquestionable. So long term, you will make some steady returns. But I think the core theme at this point I would look for is higher operating leverage rather than pure staples.
Manish, what's the rationale behind the exposure to cyclicals, particularly power, energy, that segment of the market. If you could talk us through that, because I see that it's also something that you've re-looked at recently.
So one thing I think maybe tactically, not very structural, but at this point it does look like the global economy is recovering faster versus expectations than the Indian economy. Clearly, our lockdown period has been longer than what we thought probably 2 months back. The amount of activities which are restricted is much more than a lot of countries in the West. And the cases are not coming down to the level we would have hoped for. On the second side is also the fact that given the fiscal situation we had before entering the crisis, obviously again the fiscal stimulus is something which has been less than what people hoped for. Given all that, I think I'm quite positive on a lot of these global-facing sectors, which is global auto or energy or IT, because U.S. definitely seems to be coming back quite strongly. China has already come back quite strongly. So, and a lot of these stocks also had got beaten up quite a lot. So if you see the price action of the global markets, you look at a lot of the cyclical bellwethers in industrials, in commodities, all of them have come back 30-40% from their lows. The commodity prices have come back. Crude has come back all the way from 0 literally to 30. Aluminium, copper seems to be stabilizing with the upward bias. The emerging market currencies seem to be stabilizing. They've started appreciating a bit, although yuan looks a bit dodgy. So I'm saying the global markets generally seem to be pointing to the fact that there is some signs of recovery building up, because obviously as the economies relax the lockdown, the economic activity will go up, so commodity consumption and prices should trend upwards. So at this point, I feel that some of the exposures to IT, energy, global auto is a good place to be.
That's a really interesting view, Manish, and good to sort of understand that better from you. As you mentioned, we're seeing a recovery faster when it comes to what's happening around the world than back home, where we're still underperforming. And now there seems to be some risk possibly on the food security side with what we're seeing, on the agri front, the locust attacks and so on and so forth. What are some of the risks that you're tracking back home? Where do you see the most potential for a downside?
So I think the biggest risk, of course, has to be that on the health side right now, in the sense that if the cases don't come down or they stabilize for a certain time, we open up, and after opening up, we realize that the cases are shooting up a lot. I think that obviously has to be in terms of near term, and it's a very big risk in that sense. If the cases shoot up after most of the states open up, it can be pretty detrimental for the market sentiment and fundamentals as well. Other than that, I guess we obviously, as I said, have not given a very deep fiscal stimulus. Our monetary stimulus has been working out slowly. Now the transmission is happening. But again, in terms of quantum, if you see what corporates and home loan borrowers were paying pre-COVID to post-COVID, it probably is not very, very substantial delta in terms of the rates you're paying. So I think the risk has to be that a lot of leveraged entities still, although the good part, I think, for India is we've been through a deleveraging process for 5-7 years. So a lot of the bulky leverage in terms of steel, power, infra got taken care of 2-3 years back. But again, ultimately, there is a 100 lakh crore banking system advances. There is an NBFC system, which is 25% of that. And if too much of it goes bad, then the recovery may be just constrained by the capacity of the financial system and let's say if some big credit events keep happening every 2-3 weeks or every couple of months, then the monetary transmission may not happen, and we may be in a situation where the financial system constrains the growth, even though the household balance sheet may be okay, even though there might be demand, but you also need to finance that demand. And if the PSU banks, NBFCs are all constrained for capital, and there is a kind of trust deficit which makes, let's say, NBFC bonds keep trading at 10-12%. If you're not able to solve that, then I think that recovery, even if it comes, will be very, very tepid. So that's the other risk I see.
I want to play an excerpt of my conversation with, or our conversation rather, with Indian hotels. And Manish, I'm coming right back to you because I know you have ownership in hotels and some of these consumer discretionary stocks. Let's hear out Puneet Chatwal on why he is not that bearish. In fact, he feels that this will be a tough year. Next 12 months could be rough. But as a franchise, this crisis will only make life better for Indian hotels.
All is well at Taj, and you rightly say that, Taj stands for trust, awareness, and joy. And I'm glad that in this time of pandemic, we have been able to rise to the occasion and inculcate or reinforce the trust that we have cherished over 100 years of our stakeholders. So I think it's very nice to see that.
Manish, would you be tempted to look at hotels, airlines, travel and tourism? Because for those who tell me that these sectors are in problem, I guess even the panwala on the street knows that hotels will have a bad year and airlines will have a tough year, and even tourism is going to have a very, very difficult period. But markets, you have to look beyond 2-3 years, maybe beyond 4-5 quarters, and you have the ability and perhaps the vision to do that. Are you looking at buying an airline stock or a hotel stock or a travel tourism company?
No, definitely. I think these have to be part of your portfolio. Now, the weights to that is something you can try to calibrate based on whatever data you want to see. But I do think that you have to be overweight those names because, as you said, and I agree that maybe on 2-3 year basis, if not, let's say you buy 5 of these cyclical stocks, one may not work, but the 4 will give you such a healthy return that it will make up for that one which the cycle doesn't come back. The weights is something which is bit of this thing, the pace at which you buy, because clearly you can argue that if the cases keep shooting up, or in winter if the virus comes back, your return will be even more back-ended than you thought. So I think it's more about how you want to manage the weights, but I do think that you have to be overweight. Now, again, there are multiple cycles to play. You have real estate, you have cement, you have hotels, as you said, you have malls, you have aviation. So again, maybe out of 10 cycles, you choose what 7-8 cycles, because there could be 1 or 2 cycles where supply comes in too much, or where the consumer behavior may change, or where the recovery is so back-ended that by the time it comes, another macro shock may not, whatever be your thought process. But I do think that if there are 7 or 10 cycles which have got beaten up because of the virus, most of the stocks for 2-3 years, and then assuming 2-3 years, economic activity will not come back to where we were in FY20, and I think that's too tough an assumption.
(2011 or 2010, I don't remember the year, but we had a conversation and where you said, look, my big idea is to buy general insurance. My big idea was to buy pharma, and you bought into stocks like a Cipla, or you bought into Bajaj Finserv. Are there any large big picture ideas where you are able to identify in this kind of a market where you said, look, post COVID, this is where I think I'm going to put a lot of money, because I think the earnings the big picture, the size of the opportunity is now staring at me.
So, because I still think general insurance is okay, but to be honest, frankly, I have not found, the kind of sector which from virtually zero presence in stock market becomes 2 lakh crore kind of revenue or something. At least I'm not able to see something like that. I think the theme today, which we are trying to play as a house, is more fragmented, that try to be in a leader in a debt-ridden sector, try to be in the survivor, and because of the down cycle, the survivors or the best balance sheets are also cheap. So by operating leverage with a good balance sheet, I think that is the thought process we're playing. I would love to have a sector, as you're saying, which goes from zero to 1 or 2 lakh crore kind of revenue sector. But to be honest, the economy has been so weak that it's difficult to see the emergence of many new sectors. And a lot of it is also happening in the private equity space. Obviously the e-com and a lot of the technology plays are getting dealt with more in the private equity space than coming to public markets. So in the sense, we've been devoid of that piece of action. But in the listed space, very difficult to see any big new sector. I mean, a sector is very small. Chemicals is obviously one space, but it's been kind of discovered, I think.
Sure, Manish, good to have you on the show today.